The Intelligent Investor by Benjamin Graham and Jason Zweig, the greatest investment advisor of the 20th century. Benjamin Graham taught and inspired people worldwide. Graham's philosophy of value investing, which shields investors from substantial error and teaches them to develop long-term strategies, has made The Intelligent Investor the stock market Bible ever since its original publication in 1949. Over the years, market developments have proven the wisdom of Graham's strategies. While preserving the integrity of Graham's original text, this revised edition includes updated commentary by noted financial journalist Jason Zweig, whose perspective incorporates the realities of today's market, draws parallels between Graham's examples and today's financial headlines, and gives readers a more thorough understanding of how to apply Graham's principles. For me, The Intelligent Investor is the most important book you will ever read on how to reach your financial goals. Just enjoy and learn from the quotes that I highlighted, and then apply them to your life. Preface to the 4th edition, by Warren E. Buffett. To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. A note about Benjamin Graham. By Jason Zweig. How did Graham do it? Combining his extraordinary intellectual powers with profound common sense and vast experience. There is no exact record of Graham's earliest returns, but from 1936 until he retired in 1956, his Graham-Newman Corporation gained at least 14.7% annually versus 12.2% for the stock market as a whole, one of the best long-term track records on Wall Street history. The Intelligent Investor is a realist who sells to optimists and buys from pessimists. The future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be. No matter how careful you are, the one risk no investor can ever eliminate is the risk of being wrong. Only by insisting on what Graham called the margin of safety, never overpaying, no matter how exciting an investment seems to be, can you minimize your odds of error. The secret to your financial success is inside yourself. If you become a critical thinker who takes no Wall Street fact on faith, and you invest with patient confidence, you can take steady advantage of even the worst bear markets. By developing your discipline and courage, you can refuse to let other people's mood swings govern your financial destiny. In the end, how your investments behave is much less important than how you behave. Introduction. What this book expects to accomplish. No statement is more true and better applicable to Wall Street than the famous warning of Santayana: those who do not remember the past are condemned to repeat it. The fault, dear investor, is not in our stars and not in our stocks, but in ourselves. In an article in a women's magazine many years ago, we advised the readers to buy their stocks as they bought their groceries, not as they bought their perfume. The really dreadful losses of the past few years, and on many similar occasions before, were realized in those common stock issues where the buyer forgot to ask how much. Commentary on the introduction. In short, if you failed at investing so far, it's not because you're stupid. It's because, like Sir Isaac Newton, you haven't developed the emotional discipline that successful investing requires. Being an intelligent investor is more a matter of character than brain. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. The intelligent investor dreads a bull market, since it makes stocks more costly to buy. And conversely, so long as you keep enough cash on hand to meet your spending needs, you should welcome a bear market, since it puts stocks back on sale. Let's move to the highlights from the book. Never add more money to this account just because the market has gone up and profits are rolling in. That's the time to think of taking money out of your speculative fund. To enjoy a reasonable chance for continued better than average results, the investor must follow policies which are 1. Inherently sound and promising, and 2. Not popular on Wall Street. Buy cheap and sell dear. All of human unhappiness comes from one single thing: not knowing how to remain at rest in a room. Blaise Pascal, Graham urges you to invest only if you would be comfortable owning a stock even if you had no way of knowing its daily share price. According to the Motley Fool, you would have trashed the market averages over the last 25 years and could crush your mutual funds by spending only 15 minutes a year on planning your investments. Best of all, this technique had minimal risk. All you needed to do was this: take the 5 stocks in the Dow Jones Industrial Average with the lowest stock prices and highest dividend yields. Discard the one with the lowest price. Put 40% of your money in the stock with the second lowest price. Put 20% in each of the 3 remaining stocks. 1 year later, sort the Dow the same way and reset the portfolio according to steps 1 through 4. Repeat until wealthy. You've got to be careful if you don't know where you're going, 'cause you might not get there. Yogi Berra. The only thing you can be confident of while forecasting future stock returns is that you will probably turn out to be wrong. The only indisputable truth that the past teaches us is that the future will always surprise us, always. And the corollary to that law of financial history is that the markets will most brutally surprise the very people who are most certain that their views about the future are right. When you leave it to chance, then all of a sudden you don't have any more luck. Basketball coach Pat Riley, as an old Turkish proverb says, after you burn your mouth on hot milk, you blow on your yogurt. Because the crash of 2000 to 2002 was so terrible, many investors now view stocks as scaldingly risky. But, paradoxically, the very act of crashing has taken much of the risk out of the stock market. It was hot milk before, but it is room temperature yogurt now. No matter how defensive an investor you are, in Graham's sense of low maintenance, or in the contemporary sense of low risk, today's values mean that you must keep at least some of your money in stocks. Becoming more familiar with a subject does not significantly reduce people's tendency to exaggerate how much they actually know about it. That's why investing in what you know can be so dangerous. The more you know going in, the less likely you are to probe a stock for weaknesses. Will healthcare stocks make high-tech stocks look sick? I don't know and I don't care. You're a permanent owner of both. What's the next Microsoft? I don't know and I don't care. As soon as it's big enough to own, your index fund will have it, and you'll go along for the ride. By enabling you to say I don't know and I don't care, a permanent autopilot portfolio liberates you from the feeling that you need to forecast what the financial markets are about to do and the illusion that anyone else can. The punches you miss are the ones that wear you out. Boxing trainer Angelo Dundee. The intelligent investor should conclude that IPO does not stand only for initial public offering. More accurately, it is also shorthand for, it's probably overpriced, imaginary profits only, insider's private opportunity. It requires a great deal of boldness and a great deal of caution to make a great fortune, and when you have got it, it requires 10 times as much wit to keep it. Nathan Mayer Rothschild, a great company is not a great investment if you pay too much for the stock. The more a stock has gone up, the more it seems likely to keep going up. But that instinctive belief is flatly contradicted by a fundamental law of financial physics: the bigger they get, the slower they grow. A $1 billion company can double its sales fairly easily, but where can a $50 billion company turn to find another $50 billion in business? If you live in the United States, work in the United States, and get paid in US dollars, you are already making a multi-layered bet on the US economy. To be prudent, you should put some of your investment portfolio elsewhere simply because no one, anywhere, can ever know what the future will bring at home or abroad. Putting up to a third of your stock money in mutual funds that hold foreign stocks, including those in emerging markets, helps ensure against the risk that our own backyard may not always be the best place in the world to invest. Recognize that investing intelligently is about controlling the controllable. You can't control whether the stocks or funds you buy will outperform the market today, next week, this month, or this year. In the short run, your returns will always be hostage to Mr. Market and his whims. But you can control your brokerage costs by trading rarely, patiently, and cheaply, your ownership costs by refusing to buy mutual funds with excessive annual expenses, your expectations by using realism, not fantasy, to forecast your returns, 7 your risk by deciding how much of your total assets to put at hazard in the stock market, by diversifying, and by rebalancing your tax bills, by holding stocks for at least 1 year and, whenever possible, for at least 5 years, to lower your capital gains liability, and, most of all, your own behavior. Investing isn't about beating others at their game. It's about controlling yourself at your own game. The challenge for the intelligent investor is not to find the stocks that will go up the most and down the least, but rather to prevent yourself from being your own worst enemy, from buying high just because Mr. Market says buy, and from selling low just because Mr. Market says sell. If your investment horizon is long, at least 25 or 30 years, there is only one sensible approach: buy every month, automatically, and whenever else you can spare some money. The single best choice for this lifelong holding is a total stock market index fund. Sell only when you need the cash. To be an intelligent investor, you must also refuse to judge your financial success by how a bunch of total strangers are doing. You're not one penny poorer if someone in Dubuque or Dallas or Denver beats the SP 500 and you don't. No one's gravestone reads he beat the market. If, after checking the value of your stock portfolio at 1:24 p.m., you feel compelled to check it all over again at 1:37 p.m., ask yourself these questions. Did I call a real estate agent to check the market price of my house at 1:24 p.m.? Did I call back at 1:37 p.m.? If I had, would the price have changed? If it did, would I have rushed to sell my house? By not checking, or even knowing, the market price of my house from minute to minute, do I prevent its value from rising over time? The only possible answer to these questions is of course not. Index funds have only one significant flaw: they are boring. You'll never be able to go to a barbecue and brag about how you own the top performing fund in the. You'll never be able to boast that you beat the market, because the job of an index fund is to match the market's return, not to exceed it. Your index fund manager is not likely to roll the dice and gamble that the next great industry will be teleportation, or scratch and sniff websites, or telepathic weight loss clinics. The fund will always own every stock, not just one manager's best guess at the next new thing. But, as the years pass, the cost advantage of indexing will keep accruing relentlessly. Hold an index fund for 20 years or more, adding new money every month, and you are all but certain to outperform the vast majority of professional and individual investors alike. Late in his life, Graham praised index funds as the best choice for individual investors, as does Warren Buffett. Yesterday's winners often become tomorrow's losers. One thing is almost certain: yesterday's losers almost never become tomorrow's winners. So avoid funds with consistently poor past returns, especially if they have above average annual expenses. If you're not prepared to stay married, you shouldn't get married. Fund investing is no different. If you're not prepared to stick with the fund through at least 3 lean years, you shouldn't buy it in the first place. Patience is the fund investor's single most powerful ally. The most basic possible definition of a good business is this: it generates more cash than it consumes. Good managers keep finding ways of putting that cash to productive use. In the long run, companies that meet this definition are virtually certain to grow in value, no matter what the stock market does. In investing, as with life in general, ultimate victory usually goes to the doers, not to the talkers. In short, pro forma earnings enable companies to show how well they might have done if they hadn't done as badly as they did. As an intelligent investor, the only thing you should do with pro forma earnings is ignore them. Most leading professional investors want to see that a company is run by people who, in the words of Oakmark's William Nygren, think like owners, not just managers. 2 simple tests: are the company's financial statements easily understandable, or are they full of obfuscation? Are non-recurring or extraordinary or unusual charges just that, or do they have a nasty habit of recurring? Successful investing professionals have 2 things in common. First, they are disciplined and consistent, refusing to change their approach even when it is unfashionable. Second, they think a great deal about what they do and how to do it, but they pay very little attention to what the market is doing. The cheap stocks may later become overpriced, the expensive stocks may turn cheap. At some point in its life, almost every stock is a bargain, at another time, it will be expensive. Although there are good and bad companies, there is no such thing as a good stock, there are only good stock prices, which come and go. It's well established that people often assign a mental value to stocks based largely on the emotional imagery that companies evoke. But the intelligent investor always digs deeper. Once a company becomes a giant, its growth must slow down or it will end up eating the entire world. The great American satirist Ambrose Bierce coined the word incompossible to describe two things that are conceivable separately but cannot exist together. A company can be a giant, or it can deserve a giant PE ratio, but both together are incompossible. If you buy a stock purely because its price has been going up instead of asking whether the underlying company's value is increasing, then sooner or later you will be extremely sorry. That's not a likelihood. It is a certainty. The most dangerous untruths are truths slightly distorted. G.C. Lichtenberg, in short, most managers are wrong when they say that they can put your cash to better use than you can. Paying out a dividend does not guarantee great results, but it does improve the return of the typical stock by yanking at least some cash out of the manager's hands before they can either squander it or squirrel it away. The people who take the biggest gambles and make the biggest gains in a bull market are almost always the ones who get hurt the worst in the bear market that inevitably follows. Being right makes speculators even more eager to take extra risk, as their confidence catches fire. And once you lose big money, you then have to gamble even harder just to get back to where you were, like a racetrack or casino gambler who desperately doubles up after every bad bet. Unless you are phenomenally lucky, that's a recipe for disaster. No wonder, when he was asked to sum up everything he had learned in his long career about how to get rich, the legendary financier J.K. Klingenstein of Wertheim Company answered simply, "Don't lose." The Nobel Prize-winning psychologist Daniel Kahneman explains two factors that characterize good decisions: well-calibrated confidence. Do I understand this investment as well as I think I do? Correctly anticipated regret. How will I react if my analysis turns out to be wrong? What is the typical track record of other people who have tried this in the past? If I am buying, someone else is selling. How likely is it that I know something that this other person or company does not know? If I am selling, someone else is buying. How likely is it that I know something that this other person or company does not know? Have I calculated how much this investment needs to go up for me to break even after my taxes and costs of trading? Next, look in the mirror to find out whether you are the kind of person who correctly anticipates your regret. Start by asking, do I fully understand the consequences if my analysis turns out to be wrong? Answer that question by considering these points. If I'm right, I could make a lot of money. But what if I'm wrong? Based on the historical performance of similar investments, how much could I lose? Do I have other investments that will tide me over if this decision turns out to be wrong? Do I already hold stocks, bonds, or funds with a proven record of going up when the kind of investment I'm considering goes down? Am I putting too much of my capital at risk with this new investment? When I tell myself, "You have a high tolerance for risk," how do I know? Have I ever lost a lot of money on an investment? How did it feel? Am I relying on my willpower alone to prevent me from panicking at the wrong time? Or have I controlled my own behavior in advance by diversifying, signing an investment contract, and dollar cost averaging? You should always remember, in the words of the psychologist Paul Slovic, that risk is brewed from an equal dose of two ingredients: probabilities and consequences. Before you invest, you must ensure that you have realistically assessed your probability of being right and how you will react to the consequences of being wrong. No matter what Mr. Market throws at you, you will always be able to say, with a quiet confidence, "This, too, shall pass away."